Hi, and welcome to the Intentional Wealth Update with Morton Brown Family Wealth for the week of July 26, 2021. I'm Dennis Morton here with Kate Brown and Cody Demmel. How are you guys?
Hey, Dennis. Doing great. How about you?
Good. So today we're focusing on risk, which is one of those things when we talk to our clients and we ask for their feedback. Understanding risk is consistently the number one issue where they say this is a blind spot for me. And we found two articles today that kind of are two sides of the same coin. Cody, you brought up one that was about, okay, do I have enough in retirement savings? And if not, can I juice my returns by investing in something, something faddish like a cryptocurrency, or how do I juice returns? Tell me a little bit about what that article said.
Yeah, so the article was going over if they're feeling short of their retirement savings. There's a study from the Federal Reserve that only 36% of Americans feel that their nest egg for retirement is up to the level that they need to be considered on track for their comfortable retirement. So it was just going over how if they're feeling like they're short, a lot of the people feel like, okay, well, maybe I can get more aggressive and make up the gains. And they were talking about the risk and the volatility needed to think about that.
All right, Katie, how should somebody be thinking about it if they feel they're coming up short? Like, what does this introduce when you start saying, all right, now I'm going to ratchet up the risk instead of evaluating other alternatives?
We've talked about this before. It's difficult to make up for lost time. And by increasing the risk, you may be jeopardizing your goals to an even greater extent. And so from my perspective, I think that sticking to an investment plan that's appropriately aligned and not necessarily going all in on something will help track better. But then couple that with, if you want to spend, time and energy trying to figure out, like, how do I get there? Spend the time and energy figuring out what your actual goal is, what your spending levels are, what they should be, what your savings levels are, and setting, putting the work in those areas, the spending, the saving, and the goal setting.
I mean, that's been our encounter and working with a lot of people, is that oftentimes that idea of what is enough is a question. We talk about, there was those commercials years ago, people carrying those big orange numbers around, like, what's the number that I need? And oftentimes it's a big round number. It used to be, I want to save $1 million, or I need X amount of dollars. Well, do you actually? But we also have, there are two ways you can go with this. If I have enough, if you've saved enough, you can go one of two ways. If you have enough to meet your goals, you can either say, all right, I don't need to take the risk and I can be really conservative, or I could take a portion of this and maybe take a flyer on something more speculative like that. And I don't think there's any right or wrong answer, is there?
No, it's the comfort level of the individual. Like you said, as long as you're confident in kind of reaching the goal over here, then some people fully enjoy. We're supportive. You want to take that flyer or do something fun over here and see what happens with it, but just keep it at the right level that it's not going to jeopardize the rest of the plan.
Right. It starts from that confidence that, okay, this is enough. Now I can decide whether to be conservative or aggressive there.
Yeah.
So the second thing we found was an article from Morningstar. Christine Benz from Morningstar writes some great stuff on personal finance, always offers some good perspective. She talked about the difference between volatility and risk. Cody, those two things sound the same, volatility, risk. What's the difference between those two?
Yeah, I thought it was a great article. So she dove into the difference. So she went over, so volatility is the change like in the price of a security over a certain time period. So whether it's short term, a month, or longer term, 10 years. So the volatility is the change in the price of that security or asset class, where risk is not meeting your goal. So if it's a retirement at age 62, so the risk of not having enough assets to be able to achieve that goal.
Famous investor Howard Marks has this line, risk is about the permanent loss of capital. That idea that something is very final. So if you're retired and suddenly you have to, go live with your kids because you can't afford your lifestyle anymore, that's a permanent condition. So we're talking about real long-term stuff. Has very little to do with the news of the day, right, Katie?
I think sometimes people want to remove as much volatility as possible. And the reality is there's going to be a piece of volatility pretty much every single day, but it's not all bad. And volatility actually is what helps to set you up for success over the long term.
If you are someone approaching retirement, or maybe in your early years of retirement, odds are you spent the decade of the 2000s buying the dip effectively. In your 401k, you were buying the markets at a discount for most of 2000 to 2010. and now are benefiting from a rebound in the price of those securities over the last 10 or 12 years. So yeah, it does work in your favor. This is an especially timely conversation because we're now 6 months along without having a 5% correction in the S&P 500, and those periods don't happen very often. I think it's a dozen, 15 times in the last 100 years where we've had this long a period without a 5% correction. It would be pretty natural to have that happen right now.
I think something else that was rightfully pointed out in the article is that volatility happens on both sides. We typically think of volatility as those corrections, the downside risk, but there's also the upside volatility as well. And so capturing both of those and being okay with both of those and recognizing, okay, things have been growing. It is normal if there's a pullback, and that is, all part of how things should run in a healthy market environment.
Yeah, and being a stock market investor is such a unique phenomenon because, let's face it, if there were a ticker symbol on my house or a ticker symbol on my career, I can't tell you how many times I would have sold both. Because those prices are going up all day long. I mean, we see it in housing prices this year. There's been a lot of volatility to the upside in many respects. But are we aware if our house drops in value in a given day, week, month, year? No, because they're not reporting on it on CNBC or the Wall Street Journal every day. So the volatility thing jumps in because we have this visibility on the evening news.
I think the other piece, and we talked about this before, we actually just had our webinar last week, and we talked about real returns and that there's a risk in being too conservative too. So the real return on your money is essentially being, if you have safe bonds that are earning less than the rate of inflation, then your buying power is negative. And so you can remove all that volatility and introduce a different type of risk, and you need to be aware of that. So there's, anytime you're working on the extremes, there can be implications to that.
Yeah, and she closes the article talking about how do you make volatility work for you. Cody, what are some of the things that can stack the deck in your favor if we accept that volatility is just going to be a natural course of business when we invest?
So she went over a couple ways to use volatility to your favor, as Katie said. So the downside of volatility is the most often thought about volatility. But if you are obviously contributing to your 401k on an ongoing basis, your dollar cost averaging in, or even rebalancing if we have a major market sell-off, or even on the upside, making sure that you're not overweight in certain areas, rebalancing that to use the volatility to your favor to make sure you're reducing the risk of meeting your financial goal in the future is really important.
And Katie, they use the term buckets a little bit. How do buckets play into the whole volatility management thing?
Yeah, she did highlight, and most of the people watching this are probably familiar with at least some level of bucketed strategy. I know sometimes we don't always use that language, but sometimes we do. But identifying different pools of money for different purposes. So I know we do often talk about having your emergency reserves, making sure that there's some cash that you can pull on if you need to, if there's a disruption in your life, or if things are coming up. And so identifying maybe different periods of life where there's going to be a larger draw and making sure that we have some safer money to pull from to help meet those needs, and acknowledging where we can take more risk. And so those different buckets of those, different risk levels and that can sustain different amounts of volatility.
And I think this is just one of those things where it helps from time to time to step back as an investor, as a retiree, to say, getting returns is one thing. How much risk am I taking to get there is a different facet of that question, a really important part of it. So just in conclusion, if there's something you're wondering about, how much risk you're taking, how to assess risk, we use several tools in order to determine that. We use Riskalyze to help identify how much risk we're taking in a portfolio and how much risk you can tolerate. So if this is a question that you'd like to explore with us, happy to do that. Katie, on a scale of 0 to 100, quick hits. What's your risk score, would you guess, on a scale of 0 to 100, 100 being most aggressive?
You're putting me on the spot. Obviously, we work in this industry, so we have, I'm going to say, a pretty high comfort level with investing and a high comfort level of the benefits of having time on my side and working for a number of years. So I'm pretty high in there. I'm going to say mid 80s.
Mid 80s. Cody, where do you think you're sitting?
Well, I did Riskalyze earlier this year, and I scored a 98, so very high on that scale.
I'll be the ballast here. I'm probably in the mid 70s. Just so you know, when we do the Riskalyze, the U.S. stock market comes in right around the mid 70s ballpark. Once you get up above there, then you're talking about concentrated risk. So I'll be the more conservative of this. I'm guessing I'm probably mid 70s. So, but update those.
And just to clarify, as a firm, though, we're not sticking everybody in risky portfolios. As a firm, we do very much have the kind of customized approach to each of our clients and figuring out what's going to work best.
Very true. It comes down to risk is an awareness exercise, and part of what we do is build that awareness of how much risk you can tolerate, and then how that shows up in your statements. So, all right. Well, thanks very much. We hope to catch up with you all very soon on another Intentional Wealth update. In the meantime, enjoy your summer, and we'll talk to you soon.